Hello, and thank you for joining us here today at FinTech Connect North America. This session is entitled Optimizing Commercial Payments at a Time of External Crisis. I'm Doug Mackenzie, the host of FinTech Finance's Virtual Arena podcast, and joining me today, I have some brilliant guests. Guys, thank you so much for joining us here today on this panel. First up, we have Joe Hussey, the MD Treasury at JP Morgan. We have Muneeb Shah, the Product Strategy and Commercialization Lead Payments at R3, and Matt Richardson, the Head of Product Solutions for Treasury Solutions over at Citizens Bank. Guys, thank you so much for joining me here today. I hope you're well. To kick things off, just to give everyone a bit of time to join the session and to kind of kick things off, if we could get you to introduce what you've been working on currently. So if we could start with you, Joe, if you could let us know what you've been working on, please.
Thanks a lot, Doug, and welcome everyone to the session today. So good morning or good afternoon, depending on where you're calling in from. I think a couple of things that come to mind, obviously fairly quickly and related directly to the format and the content of the session today is digitization of payments continues to be one of the forefront projects that we're working on. And it comes in two fronts. One is eliminating checks from our front end, whether that be through our lockbox or coming in through our normal channels. Sitting in the U.S. continues to be one of the primary concerns for our corporate clients, both domestically when they're getting paid and globally when they're trying to set up new vendor relationships. So those two things, and then on the other side of that is working through the multiple payment channels, what we call method of payments or MOPS, which has fairly become a common term now. Where we take an acronym and make a word out of it, I guess. But when you look at those, as those continue to evolve, is how are we paying out from both the business side to our consumers and businesses to other businesses, including the what I'll call the little Bs, which are the SMBs that we service broadly throughout our footprint.
Brilliant. Well, yeah, I'm really excited to kind of hear that perspective from the little Bs, because they've been so critical in the last 2 years because of this crisis. Now, Muneeb, also thank you so much for joining us here today. Could you give everyone here a bit of an introduction to yourself too, please?
Well, thank you for having me on the panel. We at R3 have been looking at payments in multiple areas today, right? So we've been looking at payments from the purview of the central bank digital currencies, stable coins, etc. We've been looking at payments with respect to how do we optimize the entire B2B payments landscape, particularly considering that these digitally native ecosystems that are now coming up on Ledger or otherwise, and how do we bring them together with existing payment rails, in fiat currency. So that's something that we are very, very deeply involved in. But what we have also been working with some of our customers and partners is to look at ways in which we can redefine the underlying payments infrastructures to be able to aid this, new process of digitization. Because if we do talk about digitization, but we are still using the same underlying rail, so we are still sort of bound by it and handicapped to a certain instance. So what we are looking at is, can we transform that underlying payment rail and bring digitization to that level of optimization wherein it's more efficient, more transparent, more real? And I think we're going to talk about a little bit more today on that as we go through the panel.
Definitely. I mean, it's so clear that underlying everything is the infrastructure, and it's going to be so critical in looking at this new way of thinking. You first got to maybe dismantle or look at new ways of working on that infrastructure side of things. So yeah, thank you so much. And also, Matt, thank you as well for joining. Could you also tell everyone a bit about yourself and your work at Citizens, please?
Sure. Thanks, Doug, and happy to be here. Welcome, everybody. Much like Joe, we're working on a couple of different fronts in terms of both expanding the options that our customers have in terms of making payments, B2B, B2C, and also helping them with the process of automating the processes around their payments. I think our customers are very interested in digitizing, and helping them not only with the payment itself, but the process around the payment has been very important.
Yeah, and that automation side of things is, as you mentioned, from bouncing off what Joe was saying as well, it's going to be so critical for those little Bs, because they're often so time poor. Now, guys, to look at the big picture then, let's kick things off in the most holistic view we can. Commercial payments have evolved rapidly around the world in the last 5 years. So, Muneeb, if I could come to you and look on that kind of tech side, what have been maybe some of the more technological milestones behind these innovations that have kind of got us to the situation where we actually kind of got through 2020?
I think, if you look at commercial payments and we take a step back, right? So we've been traditionally looking at enabling commercial payments through checks, as as my esteemed panelists mentioned here. We've also been looking at bringing to the forefront, internet banking portals and leased lines and host to host and VPN and whatnot to enable our corporate customers to make those payments. And then we took a step forward with open banking and APIs coming into perspective. We are now looking at integrating fintechs, payment services providers, etc., with banks and corporates to enable a more robust payments infrastructure to be able to process the payments. The underlying cause, to be able to be doing this is to enhance customer experience, number one, but at the same time, making payments as seamless and as frictionless as possible. Now, what we do from a technology perspective is we are looking at three or four key factors. So we are looking at convenience from a user perspective. How do we make it more seamless? Number two, we are looking at how do we reduce the cost of the payment by itself? And number three, the most important, how do we reduce the clearing and the settlement time frame? Leveraging technologies, right? So while we do understand that there is a lot that goes behind the technology in terms of the regulatory frameworks, the current payment infrastructures, et cetera, but as I said earlier, we are very deeply involved with these payment infrastructure providers today to understand how we can radically transform that. One simple example is if you look at from a cross-border remittances standpoint, and most of our commercial customers, do a lot of B2B cross-border remittances. Can we possibly do a cross-border remittance in a local account and a local currency, which means you don't pay as much as you do for FX? You don't pay for the charges of cross-border remittance, and at the same time, you get the payment across almost same day. And can technology aid that? Absolutely, yes, we're heading towards that.
Now that's interesting because obviously those huge changes to customer demand are also, have also been driven in the past, in the last couple of years, from those technological points have also changed customer demand. So with that in mind, then Joe, if I could come to you, and what have been some of the biggest milestones behind these innovations from the customer side of things that have enabled these innovations? Sorry, Joe, we have you on mute. Apologies.
There we go.
A double click.
Yeah, that has to happen on every conference. I think, as you mentioned, the whole idea of the transformation, it's occurred on both sides. And one of the things that you mentioned was APIs, and I think APIs began the transition to where what we call here, which is any payment, anytime, any place, right? So how do you continue to evolve that? I'll give UK credit for the faster payments initiatives that occurred so long ago, and we're still talking about that in so many jurisdictions as innovative technology that's coming to the forefront. And I think folks from the UK are like, "Are you kidding me? Now we're ready for second generation." But we have to recognize that I think there are 19 currencies, 19 countries that are sitting out there today with ready to mobilize around a faster payments, a real-time network, all of those things. You mentioned the cross-border component that can quickly come into that. I think that will evolve over time as innovation starts occurring around the outside. But to go back to your question, what has really moved the needle in the last, let's call it 5 years? I think when I look across that spectrum, clearly mobile banking has started to become part of that, where we've always had some degree of internet banking in our consumer businesses. We've always had a lot of reporting and some degree of origination, at least in the high value systems within our portals. At this point, we've moved well beyond that to where we have multiple ways where clients never actually log into our systems anymore, right? They're using APIs, they're embedded within their system. I think the overall progression of the in-house bank scenario within our large corporate clients has changed the dynamics as to how they center their banking activity. So, where before they probably had, better than I do, probably 6 or 7 financial centers sitting around the globe, usually in each of the large LATAM, Asia, UK, usually set there for EMEA, US or Canada typically, and then you throw a couple other low-cost service centers that are sitting in Asia, where now those have been consolidated, and through efficiency, then they demand that same efficiency back of their financial institution. And we're having to relook at how do we process payments and how do we deliver data. And the old adage that the clock and the sun had to keep in line, that doesn't always matter anymore as much as it used to, because the client who has a Luxembourg in-house bank center, or that's where they're running their global service center, they have folks there 24 hours just like we do. So that clock moving doesn't matter as much anymore, but the data matters more important, because back to my first comment, real-time data, real-time movement, real-time reporting becomes key to those clients as to how they're reconciling. And in the end, it's all about managing the cash on the books and being able to manage their cash more efficiently. I think that's one of the things, and we can talk about it, if we get a chance. As we looked at the 2020 onset of March of 2020, when all this started occurring, how did that look different to us? In that, what was the difference then and before, and how are we managing our cash, and how are companies being able to manage their cash at that point in time?
Yeah, and I think that is going to be so critical going forward, to look at those instances. But then on the same foot, then Matt, if I could come to you, would it be fair? We've heard how maybe some of the retail side of things always came first, and then the commercial side followed suit afterwards. Would it be fair to call the pandemic a watershed moment for organizations to bring their digitization of commercial payments? And why was that different from maybe 2008?
Doug, I absolutely think it's fair to call 2020 a watershed sort of event. And I think it really exposed the fragility of paper in a way that hadn't previously been exposed in a more traditional financial crisis situation. The idea that you needed people in physical locations handling physical items during a global pandemic really was problematic. And while the actual impact of it probably could have been, or almost certainly could have been, a lot worse, there was enough concern about what could have happened to really sort of kick people into gear in terms of continuing or accelerating the process around digitizing and trying to move paper out of the system. Paper has been, there are reasons that paper has been resilient, particularly in the States. And some of the things that are, some of the innovations that we talked about just now are helping to, eliminate some of those reasons that paper has been so resilient, and allow people to move towards more complete digitization. And I think that some of the surrounding technologies, whether they're APIs or artificial intelligence, have improved to the point that some of these solutions around payment processes are better, more reliable, and customers are more willing to embrace them.
Interesting. Now, I'm going to come on to paper in a second, because we've alluded to check throughout the opening salvo of this conversation. But before I do, Muneeb, if I could come to you and look at the kind of the UK perspective. Obviously, Joe mentioned the real-time payments drive back in 2008 as well. What changed here as well? I mean, Matt has also alluded to the fact that you couldn't just be handing people actual paper anymore. It wasn't safe. But from the UK side of things, what was the pandemic watershed moment, considering that we did have that digital payments innovation, change, revolution, whatever you want to call it, in 2008 from real-time payments?
So I think, it's fair to say that we were sort of, ahead of the curve in terms of being far more digitized, or being able to enable, our end users from a payments perspective to transact cross-border or domestic more digitally today. But having said that, if you look at it within the UK context and from a domestic payment scenario standpoint, it's still reasonably okay. But when we do commerce, it's usually cross-border. Now, end customers in UK will be working with somebody in China, and elsewhere in APAC, and because of COVID, the whole supply chain processes got disrupted, which meant, if I was working with somebody for the past 30 years, being my supplier or vendor or partner, I might not be able to work with them anymore, which means I now have to be reliant on some other party who I have not met, not known, do not trust as much as I did before. So enabling those core processes with them, getting them on board, setting up the payments processes, setting up the invoice, and the whole procurement processes from accounts payable and receivable standpoint has been challenging. And there has been no exception to UK for that as well, irrespective of the fact that we have a very, very robust payment system happening here. And that is where we have been coming into perspective to think, how do we bring trust in a trustless ecosystem using these new age digital technologies like DLT, right? So how do we enable commerce, say, for example, for a trade to happen between two counterparties using Ledger, and at the same time using the same ledger for a payment to manifest, not necessarily in cryptocurrencies, not in stable coins, not in digital currencies, but providing a rail by which this particular core business process can now integrate seamlessly with the bank and enable the payment. So what it does is serves two purposes. One, that you have one single proof from a reconciliation standpoint of a core business process through to a payment, and then it's more transparent and auditable. And coming back to the point that Joe made earlier in terms of, for example, for companies who have their own in-house banks, et cetera, and we have done a bit of optimization in that space. At least I have a very interesting anecdote. I was working with a customer in US, a large manufacturer of electronics goods, had close to around 125 SAP systems and 1,000+ bank accounts, were running a third-party, in-house bank. But that also, as Joe very rightly said, does not solve the problem unless you have the right data at the right place at the right time. And in the current world, the way these in-house banks and in-house payment factories work is that you have to be reliant on asking for data from the relevant parties to be able to reconcile their data and pass that through. What we are talking about is bridging that gap, right? So how do you make data available real time in a way that it's immutable, cannot be tampered with, but at the same time can be used for your business processes? And that's where we are implementing DLT.
That's absolutely incredible. Now, we have now brought up the chat, distributed ledger technology, and obviously blockchain's coming up soon. So I think we need to kind of take a step back before, go from the paper before we start running with the distributed ledger technology. So if I could come to you, Joe, and look at the check and its role in North America, what will that mean? Will external crisis like the pandemic finally mean the death of the check?
So funny you should say that. When I was interviewing, and I'll just give my age here, in the 80s, one of the persons I was interviewing for said, basically that before you retire, the check will be long gone, right? Well, unfortunately, newsflash, I'm closer to retirement than I was back then, and the check isn't anywhere near being long gone, right? I think the check is asleep, is what I term it with my team. We'd like to keep it asleep, but there are still probably, when we get the next study out in the US, 14 billion, 13 billion, I mean, depending on how aggressive we were in 2020 at converting them, there'll still be a good number of checks sitting out there. I don't think we have a good, easy solution to eliminate the check. And I know that kills people in EMEA when I say that, because they will say they've solved that already. But we do not have, with whatever we have, 12,000 banks in multiple different ways, and no centralized directories such as what Canada has started. I don't think we have an easy pathway. And the only way I see a quick transition away is you have to marry the invoicing information that's still so key for most folks when they get the check to their receivable system. And without it, it really just becomes a very high cost electronic payment for them that they're trying to reconcile. So that's where we focus a lot of time, is when we're trying to convert a client. How do you ensure that the data that followed the check is continued in that payment stream, without just electronifying it? And I think we've made big progress. ISO has certainly shown that it has an opportunity to do that. I think there was fear of ISO for a long period of time. I think as generations have changed and and our treasury staff has changed. I don't think there's a fear of ISO anymore, but that now what we have is how much change can we actually affect on our treasury organizations? And by doing that, these things tend to fall down because a lot of the things we're looking for is faster liquidity, faster cash movement, those kind of things. And sometimes balancing that and measuring the cost of the check, not from the paper like we always do, but from the cost of the how long does it take to process and where does it put you in your queue, falls down a little bit to some of the other liquidity and cost of funds initiatives that are probably popping to the top when we look at our development queues.
Well, with that in mind, and Matt, I'm also going to throw the check question to you as well. But before we go any further, we actually did receive a question from the audience, and it loops into the question I brought up. Why is this different from 2008? And you were speaking on liquidity there, Joe. How do you think this?
So we've looked at this really closely here, and I think when you take the two events as separate events, likened in some way without a doubt, but the reality is the two events had very different underlying circumstances obviously sitting behind them. One was a global mortgage crisis that led to a overall liquidity credit tightening that happened so quickly that managing that liquidity became problematic. The pandemic, if you will, became a question of, do I have the staff and can I move funds around? Once we got past, let's say, the first 3 weeks from March 11th through March 30th, March 11th, March 15th, depending, that's generally the date that JP Morgan uses for when the pandemic actually began. Of course, we're the US, so when your sports team shut down, that must mean that the pandemic has begun, right? Just because there's no more sports to watch. So I use that as kind of the initial pivot point when we went into there. And yes, there was quite a lot of concern. And if you were watching the financial markets, there was volatility that came out of that first probably 8 or 9 days. But then we really saw that start to soften. We saw a lot of clients being able to raise money fairly quickly. A lot of them were doing it as probably more as an insurance policy than necessity, not knowing what the next 2 quarters were going to look like. And if you recall at that point, we were still under this, at least here again, speaking domestically, we were under this idea that we were going to wear a mask for a couple of weeks and the virus was going to go away and we were going to go back to normal. Well, we quickly figured out at the end of March that wasn't likely to happen. And I think then the liquidity fears, everyone started settling into, how do I manage in a new environment? And after a few bumps that we had to get over, not the least of which was, how in the world do I sign checks when I'm remote and the signer is not with me anymore, right? That liquidity problem pretty much vanished from the narrative that we were talking about, and it became, okay, how do I manage my business and what partners do I need to quickly start reaching out to? Because if I have a high value invoice that's coming in, I'm going to have to get those paid. And if it was going to be paid by a check, and especially if you think of a utility company or oil and gas and some of those things that are dealing in quite a lot of minerals and hard materials coming through their operations from a sales perspective, that's pretty important that comes in, but it's also just as important to your counterparty because they're needing to produce whatever, the goods that they're producing. So I think there was a general consensus that we've got to make it work, and that quickly quickly eliminated most of our liquidity that we didn't see like that in 2008 to 2009 and even into 10 to some degree, because we were still trying to settle out the financial markets globally.
Now, that's interesting, and I'm also excited to kind of hear, Matt, your perspective on this as well. Would you agree that when it came to the check, and obviously we've heard from SMEs, small medium businesses, enterprises, that liquidity is so critical, and obviously ensuring that the check can still get to these people is critical, to these businesses, or is critical. So, I mean, was it the same? Do you have the same perspective as Joe here when it comes to the check and liquidity?
Yeah, I agree. I think, for within commercial banking, our clients having access to everything they need online is already well established. So it wasn't so much a question of how they were going to do it as more of a question of where they were going to do it. And again, it did expose kind of the challenges with check. You had to be in the office. Someone had to go to the office to print the checks, or God forbid, they're still receiving checks at the office, handle them and process them. And there were definitely some concerns early on about the, how resilient were lockbox operations, in particular, sort of when India shut down relatively swiftly and relatively comprehensively. That caused some challenges with some of that work that was outsourced there. But I think that system did prove fairly resilient, and it was more a concern about issues than actual problems. But you can see why it's concerning. So in terms of the death of check, it's hard to call that, and I would agree with the way Joe phrased that. It's been predicted for quite a long time, and yet checks hold on. I am sort of bullish though on the opportunity to continue to move checks out of the system, and you have to have adequate replacements. And I do think as I mentioned earlier, the advancement in artificial intelligence technology is making it easier for our customers to receive electronic payments and reconcile the invoice information that might come in an email or that might have to be pulled from a website. So I think that's helpful. Real-time payments in the US is built on the ISO 20022 format, so that data can come with the payment in a standardized way, which is very helpful. Things like request for payment, which is built into RTP, could be a game changer in terms of how businesses collect from people, and those might be some level of check transactions. And then the idea of working with consumers or interacting with consumers the way they prefer to be interacted with. So businesses paying to social tokens instead of accounts. And all those things, I think, are helpful in reducing the need for checks.
Definitely. And I think you've really touched on a really interesting point there of just, it comes back to that customer choice, doesn't it? It's really, people want to pay the way that they want to pay, whatever's easiest to them. And I think it's going to be changing the nature of the role of a bank going forward, and obviously the businesses when that just becomes acceptable. Now, we were touching upon distributed ledger technology and obviously the role of blockchain there, and I want to expand that further now that we are talking about these new ways to pay and this opening up of choice. Now, someone from the audience has also thrown in another question. I'm going to tack that onto my original one, and that is, will blockchain play a significant role in commercial payments in 2020? And if we can maybe look specifically in North America. And for those of us, this is from the audience, for those of us who are not DLT experts, can you maybe walk through a simple case in which DLT can actually be integrated into the commercial payment rail itself?
Sure. But before I go to that question, Doug, I just wanted to touch base on the death of checks. Now, the thing is that, yes, the checks are going to stay, maybe for the next foreseeable future, they will be there, but we do still see a diminishing use of checks happening globally. Except for US, where it's more prevalent as of today. But having said that, if you look at a very recent Financial Times report, the consumer behavior within US has also drastically shifted during the course of this pandemic, right? So we have seen close around a 62% drop in actual ATM withdrawals and cash use in US, and more adoption towards digital channels with respect to spending patterns. And while that's more retail focused today, I do envisage that that's going to have a very, very heavy influence in terms of how commercial payments would also manifest in due course, more to do with the need of the hour rather than anything else. Now, coming to the point where do we see DLT playing a significant role? Absolutely, yes. I think, from a DLT perspective, even before the pandemic, we had already started exploring relevant use cases where we can redefine the way payments are being done. more in the B2B context standpoint. And as I said earlier, the 3 points that we considered were pivotal about, the cost of the transaction, the speed of the transaction, and the finality of the transaction. How do we bring all these three together? More importantly, as Matt touched upon earlier, and Joe also mentioned, one issue that we have been facing in the manual processing of checks today broadly, or in the manual payments processing, is how do you reconcile an invoice against a purchase order, match the two, and make sure that the payment that's getting made is consistent with the data that's present in the invoice and the purchase order. And that leads me to answer the second question. That is a classic use case where DLT can come into perspective. So what we have been bringing to the table is procure-to-pay solutions, where an invoice and a purchase order gets algorithmically reconciled with each other, and the manifestation of that process is a payment that gets triggered, right? Now that payment actually is now in a way sort of final, not from a settlement standpoint, but final in the sense that it has all the finite data that it needs for the payment to go through. And you pass that payment back to the ERP system, and the ERP system can then decide whether it wants to do a host-to-host payment or it wants to, issue a check. That's one part of it. We have taken it a step further now, where we are now basically seeing is that rather than sending this payment to the ERP system and letting the ERP system decide what to do with it, why don't we bridge the gap between these digitally native networks on DLT and bring them together with a bank or a payment services provider at the back? Which means now if you're doing your core business process on the ledger, and in the earlier days, what you had to do, and before I go into that, we have seen a significant increase in the number of digitally native solutions and platforms coming up on DLT. And we have seen good amount of focus in APAC, for example. You've seen trade finance, syndicated lending, commodity trading, multiple other solutions that are now coming up on DLT. The problem that they face today is, while they do their core business process on the ledger, they then have to go offline, go to their normal banking channels, or write a check and make the payment happen. And then somehow they have to reconcile that the payment has happened and I can continue with my core business process. The fundamental problem here has been what we call as delivery versus payment scenario, right? So there is no DVP automatically and algorithmically and atomically integrated into the whole transaction. That's what DLT brings to the table. So what we are now saying is, while you're doing your core business process on a digitally native platform like blockchain or otherwise, we are now giving you a capability of initiating your transaction from the ledger, sending that transaction through the DLT directly to a payment services provider or a bank, using signed receipts from that bank as a proof of payment back to you, and you use that proof of payment to release your assets, right? So it's basically, rather than waiting for that reconciliation to happen offline, you now have one consistent platform providing you that end-to-end view, right from your trade through to your settlement. I think that's another way I could explain the confluence of where DLT comes into purview with existing payment fiat rails.
Yeah. Now, with that in mind, then, Matt, if I could ask then, how do these increasing options when it comes to payments, how is that going to change the role of the Treasury Department going forward?
Yeah, I think there's the Treasury role is definitely evolving within organizations to be, more strategic, to turn some of these functions from cost centers to profit centers. And given the rapidly evolving landscape, there's a tremendous amount of pressure to keep up with the changes that are happening, the new options that are available. And what are your trading partners, whether they're businesses or consumers, looking for in both domestically and internationally? So I do think there's a lot on Treasury departments to sort of keep up with the latest and what's going on, and understand how they can weave that in to the tools and processes that they already have. It's a complex landscape, and in some cases you have to almost place a couple of bets on things that you think are going to be relevant for your business, for your industry, for your trading partners.
Interesting. Now, if I could come to you, Joe, and then look at how those changing demands within various different sectors, various different industries, how's that going to change the role of the bank going forward as well?
Yeah, I think there's two things that I wanted to have a quick thought on. Is that the first thing is that if you think about blockchain technology and how does it get employed, it's going to be a slow evolutionary process where I think someone will quickly grasp onto a use for it. If you remember, and we've seen this analogy before, when the idea that you could text on your phone first came out, people were like, well, why in the world would I ever want to do that? Pick up the phone and call me, for goodness sakes, right? When someone calls me now, I assume we're at like DEFCON 4, that there's a big emergency about to happen, because otherwise no one calls me. I think that's where blockchain is going to evolve as well. There will be these nuanced use cases that start with, and then as we get more comfortable with it, we will say, well, why aren't we doing more with it, right? Why aren't we able to leverage it more fully? One of the items, and you know, we spent so much on this, and we've been very public with it in the investment side of things, is that from a blockchain perspective, the movement of data and the enablement of a straight-through processing really benefits the Treasury Department and the bank equally. Lower costs on our side, less risk on our side, faster clearing and faster settlement on the commercial side. And if you think about how that just keeps evolving and evolving, and you talk about the sanction screening process, which is the bane of every high-value system's existence these days, right? And now it's trailing into low value. If you think about if blockchain can provide you that ability to quickly have an exchange of ideas or an exchange of information with your counterparty, that can all be done electronically. And you know, you can talk about machine learning and AI and all the other things, but the results is there's really not a lot of AI in going into, you know, the Joe Hussey account at JP Morgan and saying, what is your date of birth? And flipping it back over to my counterparty and saying, oh, well, you're not the bad guy anymore. You're this boring guy who lives in Tampa. Go ahead and clear the payment, kind of thing, right? Those types of things, I still think, and we still feel like, are yet to reach the groundswell of support that they will have when everyone can see the value that's coming through to them. I think, you know, to your question, how does this impact the bank, and where do we see this impacting the bank? Is I think eventually you'll see blockchain, you know, impose itself on almost all of our systems. No different than we're all trying to get our systems moved to the cloud today. I think as we move them to the cloud and as we make these enhancements, we're also looking to say, where would blockchain do this better than our current processes could do it, right? And in a lot of cases, you know, this is the baseball game analogy that I need two teams on the field at the same time. And so I have to find a counterparty that's willing to do it. And it typically is either in the fintech world or in the large corporate segment world today. But that's problematic because the most number of clients sit in between those two, right? So once you have a solution that is interoperable with both of those, I think then you have, you know, you will reach real scale on blockchain, and that sharing of data, that sharing of information, streamlining of payments is what will resonate with the clients who are really the middle market client who's, you know, trying to make cash flow today so they can make payroll tomorrow becomes key, and that they don't want any of their payments held up. And I think blockchain holds a lot of promise that they can start solving that.
Interesting, Muneeb. Obviously, Joe was mentioning there how we got to establish cloud-based technology first, and then, you know, dive into distributed ledger technology. Now, right. How can we expedite that process? You know, this whole panel is about optimizing commercial payments. How do we go about doing that the quickest and best way possible?
So, you know, I've been saying this day one since I stepped into the blockchain world around 6 years back, that, you know, blockchain is not about force-fitting this technology on something what does not need it, right? And that's been, you know, my and our organization's consultative approach always, right? So let's look at the use case that really needs blockchain first. And Joe very rightly mentioned that. Not all use cases need blockchain, and we can't implement it for that. And that's where there's a conscious approach in terms of identifying a business process, identifying the gaps in that business process, and identifying where blockchain fills those gaps in the internet. So we're not necessarily saying that, you know, throw away checks, bring blockchain and everything will be fine. It's not going to be that way, right? So we have to find a fine balance wherein, for example, can we bring blockchain to play a significant role in terms of amplifying the current existing systems to make them more efficient? Yes, there would be a time in evolution when possibly the existing systems would be at their end of life and blockchain takes over. it's still some time away from that. So, and we are very, very consciously working hand in hand with existing financial systems in terms of bringing them at par. And that's where I also mentioned earlier, when we are looking at payments, we're not looking at payments in the realm of cryptocurrencies or stable coins or digital currencies only. We are looking at payments by bringing existing payment fiat rails together with DLT to enable that, right? So that's a evolutionary process to sort of land there. And again, Joe also mentioned about AI, for example, whether we are able to use it or not. So we've seen some interesting use cases of AI very typically in terms of trying to capture the payments fraud at a corporate level, more so rather than at a bank level, right? So we've seen some solutions manifest wherein AI algorithms could basically scan through invoices and purchase orders and the payment data and flag and say, particularly this payment was a fraud because, it didn't have all the necessary data points associated with it. So that's a very powerful tool to have for corporates today, to optimize their balance sheets. Technology definitely plays a significant role there. And with, blockchain coming into parlance and potentially in future working hand in hand with AI ML solutions to solidify this space, I think would be a compelling proposition for us to look at.
Interesting. Now, moving on, continuing on that theme of AML and, something that comes up increasingly amount in the financial industry space is obviously cross-border payments and how the standards around that are improving data sets around that and also making sure all those payments are safe and secure and proper. But if we were to step back from that and look at what role the pandemic played on cross-border payments, Matt, I know we touched on this briefly at the beginning of the conversation. We've moved the conversation all the way from distributed ledger technology to cross-border. I'm interested to actually get into the deep kind of side of that and actually look at how the pandemic did affect cross-border payments and are the new international standards sufficient in optimizing them and have some of the technologies that we've brought up throughout the conversation actually going to expedite that optimization in cross-border?
Yeah, I think the pandemic for sure sort of disrupted supply chains, and there was so the ability to make those payments and to be able to track them and maintain those buyer-supplier relationships was incredibly important. We noticed a big uptick in our international trade business related to the disruption of supply chain, maybe working with new or different trading partners that you perhaps hadn't worked in before, in the need for trust in those transactions, which, oh, by the way, blockchain and DLT solutions can help there as well. So we certainly noticed those types of things. And, in the future, whether it's blockchain or whether it's interoperable real-time networks, many of which are built on similar technology, there needs to continue to be advancement in international payments related to both speed and visibility around settlement.
Interesting. Now, that visibility, it goes such a long way to the trust side of things, doesn't it? And we have seen international standards kind of bring that up. Also, international payment rails also increase that visibility for the commercial customer. So, Joe, if I could come to you and look at maybe what some of those innovations have been to improve the visibility, and is that only going to help banks go forward to play that new role in this new normal where trust is so important when it comes to a cross-border payment and also having real-time visibility of a payment going around the world?
So it's funny you say that, because I know one of the questions to us is, where do fintechs play in this? Yeah. Well, I think we've been very vocal on the JP Morgan side, not short for Morgan, from the standpoint of, if we don't, the fintechs are will have solutions out there, and without naming names, we all know there's some the opportunities out there today that have started doing it on the consumer basis, right? But I think when you look at cross-border, you have to think through, what are we trying to do? And it's very different if you're doing a cross-border tax payment, where principal always has to be protected, and there's all the rules that go around it. But then there's this whole other side of that Matt was pointing out, where we're doing a payment on goods and services that have been delivered, that have been rendered, and there's this negotiated terms up front, and then there's multiple counterparties sitting in between. that has to be simplified. And I think as we've looked to that simplification process, we continue to see the agreements that are coming into place. We see a lot of that business continuing to be consolidated because of those agreements that are in place, that you can protect that principle as it moves across border. And then I think I think Muneeb mentioned this earlier, where there's this idea of a cross-border, non-cross-border payment, where I'm doing a payment, but yet I have a JP Morgan account sitting in London, so I don't need to do any cross-border in sterling or anything. I'm just going to move it, but yet there in the background, there's a lot of, there's financial accounting being done, and there's an efficiency that's playing there. I think that starts to come into play, especially as we look at our upper middle market customers that will start doing some of these cross-border transactions. If you look beyond where I sit, beyond Canada and Mexico, which obviously has a tremendous amount of cross-border trade that has fairly good rules that are set in place, not that there aren't rules other places, but those rules are consistent. I think when those clients size dictates that they start dealing, especially in Asia, which has become important from a supply chain perspective, and then Europe from a financial perspective. So if you separate those two, how are you investing? How are you paying? And where are you getting your supplies from? Getting clients that ability to simplify Asia into both Europe and into North America is just as key as then what we've always done, which is there's these financial transactions that move between our shore and usually EMEA and either Frankfurt or Dublin or London today probably. That change, the simplification of that, whether that can be enhanced by blockchain, as Muneeb was pointing out, I think the bigger challenge or the next step in that is this network that's being created amongst many of the financial institutions to ensure that they have, I think your word was visibility or transparency along that entire chain. And then here again, I call it the pizza tracker. The client wants to know where that payment is at every point in time. When I order something from Amazon, there's nothing more exciting than when I get up the next morning and I see it's already on a truck headed to my house, right? Yeah. I think that same level of transparency is become almost standard and required to our business clients, so they know where the payment sits. It helps them both from an internal management of their receivables, but also helps them that they can be fairly they have more leverage in negotiating contract terms when they can follow that transaction all the way through.
Yeah, and I think it's so critical because, as you mentioned, these cross-border transactions aren't just one, inter-country. They're cross-continent. They're multiple countries, and this in commercial payments. You need to have that visibility across the whole chain. Now, with that in mind, we've talked about the need to optimize in terms of how it's going to improve your experience of a payment and how that's going to be critical, seeing that visibility. But if we were to look at actually optimizing it as a way to improve operations, you touched on it slightly at the end there, Joe, actually. But Muneeb, if I could ask you, did the pandemic highlight how businesses and organizations need to optimize their payments more from just a customer experience angle, but also on an operations side because of a knock-on effect?
Absolutely, because maintaining their APAR has been key, right, for most of the organizations. So getting end visibility in terms of what their liquidity positions are end of the day in real time would be a boon for any organization today, right, rather than starting looking for data. So I think that's one of the most relevant implications of the pandemic, that we need organizations to have clear view about the liquidity positions end of the day, right? Can we enable that today to a certain extent? Yes, but not as real time as we would think for that to be. And the underlying factor here is that whatever we want to do from a digitization perspective to change the customer experience, we can do only as much as the underlying infrastructure or the regulatory framework allows us to do. So unless we go to the root of the problem and look into these dinosaurs and say, how do we change this and bring them to a level of abstraction wherein they can aid this overall digitization process, we are phenomenally lagging behind. And we are, from a technology perspective, invested in terms of looking into those areas more deeply, trying to identify, how does the building block change to enable change at the front end? I think,
interesting. Yeah, and with that in mind, then Matt, how do you see things in the United States and North America changing to that, changing that infrastructure? Does it have to come from a regulatory point of view, or is it a technological point of view, which by just changing the infrastructure, what's going to be the first kind of straw to kind of kickstart this optimization across the board?
Well, in the States, there's been a decided lack of sort of a regulatory mandate to do some of these things, especially, faster payments. The government has been involved in it and has announced that they're going to develop and roll out a scheme. But the challenge here, unlike in many geographies, is there is no requirement, there is no mandate, at least not yet. So that ubiquity is a little bit harder to come by. I would also, going back to Muneeb's point a little bit, I would also sort of highlight when we think about payments, the onboarding of customers and the enabling of the services became a huge priority throughout the pandemic, whether it was traditional payment services, whether it was provisioning PPP loans. That whole aspect of it was a huge necessity during the pandemic. And I think that will continue when we're talking about end-to-end digitization.
Amazing, guys. I think that's all we have time for, but a brilliant note to end on is, that kind of looking towards the future there and how we can actually action it. But guys, thank you so much for all your insights. It was absolutely incredible. And I felt like we could talk about that for another hour or two, but guys, thank you so much. And I hope also everyone who attended the panel enjoyed it as well.